Hi, it's Nick Jevick with Private Placement Pro. I want to take a few minutes to walk through this equity pricing model that I've put together in Excel. And this kind of piggybacks on an article and a video tutorial that I've done that walks through 6 easy steps on pricing your equity. And it really came out of a lot of questions that I got from people that had purchased some of my private placement templates, and when it came time to pricing their equity and figuring out how much equity to give up in their warrants and their preferred stock offering, they kind of hit a wall. And so, it's pretty simple, and I think you can do it on the back of an envelope. But what this model does, it shortens the amount of time that you kind of got to put into it, and it allows you to run through a lot of different scenarios to really hone in on what kind of returns you think you can generate for your investors. So everything from adjusting the exit multiple to some of your growth assumptions to the preferred dividend. So anyway, that's what this model does. So this first tab is just simply the instructions for some of the tabs. The assumption tab is just that. It allows you to put in the assumptions for your transaction, starting here in the sources and uses, where you'll put in the purchase price of your acquisition. You can identify a lot of different expenses, the amount of financing you're going to need, or that you think you can get, and then that drives the financing gap, which I assume is going to be filled by investor preferred, and then out of that investor preferred, how much money that you're going to put in, both as a preferred and a common shareholder. And what I always tell people is to just put a nominal amount in common, and really the bulk of your co-investment to be what they call pari passu, so on the same terms as your preferred investors. This next tab here is just for information. It provides you a view of the opening capitalization of the transaction. So, all the capital, the debt, and the preferred and the common. The percent of total capital. So in our example here, you can see 60% of your financing is coming from debt, 40% roughly coming from equity, and then a cumulative multiple of EBITDA. This next tab is where you'll input the assumptions for the growth of the company. And so what I've done is I've tried to make this easy so that sometimes people want to just look at growth on a percentage basis, and some people actually want to put in dollar amounts. And so I've got a little switch here, and so whether you put in a 1 or a 0, it's going to pull either percentages or the dollar amounts into the forecast, which is down here. And so in our example here, I'm for the first 4 years, I'm just pulling numbers from these actual dollar amounts that I've inputted. And then starting in year 5, I've just used some growth percentages and EBITDA and gross margin percentages. And then down here, what I've not done is, built a full model with a balance sheet and statement of cash flows, which, you really should do. But again, this is to get a reality check on your offering and to make sure that you're not either offering too much equity or not enough equity in the deal that you're trying to put together. And so down here for estimated debt and cash, really what you'll need to do is just use your best judgment on how much debt and cash that you're going to have in these various periods. And so what I've done here, again, just to be conservative, is just assume that you have a line of credit and it's sweeping your cash, and so we've just made that 0. You can obviously put in, whatever number you want in here. And then finally, we get to this last tab, which will show you what the returns are for the deal that you're putting together. So again, the financing gap is the preferred stock, and up here you can put your assumptions for the preferred return or the dividends that you intend to pay to the investors. Again, another switch here that will allow you to designate whether your preferred return or your dividends are going to be current pay, so you're going to pay them out in cash on a quarterly basis or annual basis, or 2, if they're just going to be paid in kind and they're going to accrue over time. And that does affect your returns. The amount of equity that you'll need to give up for to achieve certain returns, which is down here in this first blue line, the preferred IRR, and then your exit multiple. Normally, I like to just use my going in multiple just to be conservative, just to see, what that deal looks like. If you do think that you can grow your company and you can make it a lot bigger than it is when you bought it, then by all means take advantage of multiple expansion because it does great things to your IRRs. And then you can see here, you can, typically preferred stock is a 5 to 7 year holding period, but you can see what it looks like for each year based on the growth numbers and then the assumptions for your transaction. And so with what we have here, returns in the low to mid 20s really doesn't look that appealing. And so, you can play with that either by going back and saying, listen, I really need to figure out how to grow the business a little more, or I need to pay down debt a little quicker, or I need to really figure out how I can get a larger multiple on an exit. Or maybe it's as simple as, listen, I'm going to pay an 18% preferred return. And so you can see, what that does, keeping everything else the same, what that does to my returns. And so you can see here that, returns now in the 30s, probably makes a little more sense. So anyway, that's it. Really simple to use. It's, trying to help you guys figure out how much equity to give up. Again, just from 20,000 feet. And, you can always do this by hand, but this little model just makes it a little quicker and easier. Anyway, this is Nick Jevick with Private Placement Pro. Thanks for watching. Take care.